a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about dividend ETFs, particularly dividend growth ETFs. So we know that 2021 was a great year for the stock market. The S&P 500 has in fact doubled since the start of 2018, and that was thanks mainly to ultra-accommodative monetary policy and a massive fiscal stimulus. Now, those things are changing now, and that is why 2022 has started on a rather volatile note. We have seen the seesaw in stocks over the past couple of weeks, and inflation, rising rates, the Fed, and COVID. These are the top concerns for investors now. And inflation has mainly been caused by the supply chain disruptions around the world and a tightening labor market in the US. And we have seen that China's zero tolerance policy for COVID has resulted in frequent lockdowns across its ports and factories. So that may keep supply chain disruptions at and elevated levels in the coming months, and wages are also expected to remain high because so many people are leaving jobs. We have seen the labor market is very tight, so that means inflation is expected to remain high, and the Fed is expected to raise rates starting in March. The probability of a Fed rate hike in March has gone up to over 80% now, and there may be many other rate hikes, maybe 3, maybe 4, maybe 2. Goldman Sachs expects 4 rate hikes in 2022. So what lies ahead this year? We will likely see a slowing earnings growth. So the current expectation for US stocks EPS growth is around 9%, which is very impressive, but this doesn't look as good as double-digit gains in 2021. And the GDP growth is also likely to come down, and the current expectation is around 3.3%. So in this muted gain environment with growth, muted growth environment with growth slowing and rates rising, volatility is expected to remain elevated. Now, when rates are ultra low, investors do not really care about profitability. But when rates start rising, profitability of their holdings becomes a big concern for investors. So that is why it makes sense to invest in profitable, high-quality companies and which have a solid balance sheet and a history of strong cash flows, and which have been paying dividends and also increasing their dividends. Sustainability of dividends is also important. It makes sense to invest in those companies, those stocks and ETFs, and also these stocks are more from defensive areas, which are likely to do well this year, and investors which have a lot of exposure to cyclical areas of the economy, and particularly high growth companies or megatech stocks, they can diversify their stock exposure using these ETFs. So let's take a look at 3 ETFs. All these 3 are very, very cheap, very, very popular, and they focus on very high quality companies. So let's go to the quote page on Zacks.com to look at these ETFs. So the first one I'm highlighting is by Vanguard. It is the most popular dividend ETF with over 68 billion in assets and ultra cheap with just 6 basis points in expense ratio. This holds companies that have increased their dividends consistently for more than 10 years and has about 270 holdings as of now. It is market cap weighted. Let's take a look at this ETF by going to the quote page on Zacks.com. You can read our article, our research report for this ETF. The dividend yield is currently 1.6%. And using the link on Zacks.com quote page, you can go to the Vanguard web page for this ETF and you can learn more on its strategy, what it holds. So focusing on large cap companies with a record of growing their dividends year over year. So let's see what it currently holds in the portfolios. You will see that Microsoft, United Health, Johnson & Johnson, Home Depot, and JP Morgan are the top companies. Looking at the sector exposure, industrials, consumer discretionary, financials, and technology are the top sectors. The second one which I'm highlighting is by Schwab. This is also very popular, 33 billion in assets, and this has the same expense ratio, 6 basis points, has fewer holdings, so a more concentrated portfolio in this ETF, 100 holdings. This focuses on the quality and sustainability of dividends, and this also focuses on companies which have at least 10 years history of paying dividends. Again, to learn more, you can go to the quote page, and using the link, you can go to the Schwab web page for the ETF and look at what its strategy. So as you can see, that focuses on quality and sustainability, and stocks are selected for their fundamental strength relative to their peers based on financial ratios. You will see companies like Merck, Coca-Cola, Amgen, Pfizer and Cisco in the portfolio. Now this has more exposure to financials compared to VIG, and that is one of the reasons this, and financials we know that have done very well this year and last year too. So this ETF has also done quite well. Then information technology and consumer staples and industrials are the top sectors. The third one that I'm highlighting is by iShares. It is the iShares Core Dividend Growth ETF, ticker symbol DGRO. This also looks for sustained dividend growth. Holdings are selected by dividends, dividend growth, and payout ratio. This is more diversified of the three, most diversified of the three, with over 400 holdings. And this is also very popular with 24 billion in assets and 8 basis points expense ratio. Again, you can learn more by going to the quote page. The dividend yield is over 1.9% as of now. And top holdings in this ETF include Pfizer, Johnson & Johnson, Apple, Microsoft, JP Morgan Chase. And looking at the exposure, financials, information technology, healthcare, and industrials are the top holdings in this ETF. On the last slide, I have the comparative performance versus S&P 500 over the past year. Now, these companies are boring companies. They are not as sexy as some other high growth companies. So they will not do very well in when the stock market is on a very bullish note. But when stock market is slowing down, these may continue to do well. So over the past year, these ETFs delivered between 21 and 26%. S&P 500 had a return of about 24%, and the best performer was the Schwab product of the three. And in full disclosure, I own VIG and DGRO in the ETF investor portfolio.